Hello everyone, welcome back to my channel. So in this video I'm going to provide an overview about the trades that we did earlier this week on both the Alcoa company and Alcoa Corporation rather, and also on American Airlines in an attempt to capitalize on their upcoming earnings release. And specifically, I'm going to I'm going to cover all the mistakes and the reasoning behind those mistakes when it comes to setting up those positions. Now, to start from the beginning and coming here to the beginning of the week, I set up a long strangle on Alcoa. Let's just start with Alcoa. So basically, and let me just put the graph of Alcoa right here, which is also important because then we can keep track of everything that was done. So this is Alcoa, this is the stock, and this is the weekly chart. All right, so now we're good to go. So apparently, and you can see here, what happened was that for Alcoa we started by setting up a position which was basically a long strangle with a 5 lot size, so 5 contracts on each side. So we bought 5 calls with a strike price of 31, and we bought 5 puts with a strike price of 30.5. Now, if you have a look here, the stock basically began the week, it began the day rather, here at around very close to 30.50, you see. So in this case, this was a mistake, and so let's start here. Alcoa Corporation. So mistake number 1. The strike price of the long put was not correct. It was not the correct one, because keep in mind that if we have, and I'm just going to show a graph here, if you set up a long strangle, you have this long put here with a strike price of 30.50. Again, please, yeah, keep in mind that it's quite hard to do it with a mouse. So, and this is a strike price of 31, right? So this is 30.50. Let's do it again, because this is pretty lousy. All right, 30.50. So if the stock at the time the trade is put in is very close to $30.50, as it was the case, this is wrong. The strike of the put should be at more or less the same distance to the stock price as it is a call. And so at the time I just wanted to have a strangle in which the strikes are as close as possible to the stock price, but this is wrong. We should keep the more or less the same distance. The strikes of the calls and the puts should be more or less at the same distance from the stock price. So the 30 put, not the 30.50, should have been bought. Right? So this was the first mistake, and as a result of that, because of that, the put ended up being much more expensive. Oops, it's not this one, it's this one. As a result, the put was much more expensive than it should have been. And that means that with a very slight move, of course the put would have been in the money, which is not a bad thing, but this ended up being an added cost that we paid up front, and there because the puts would only expire later, because this was a put which would not expire at this same week. It will only expire the week after, which is the week in which earnings are presented. This means that we just paid more than it was really necessary, and without a very much of a upside to it, because even though it would be easier for the put to be in the money at that point if the stock just slightly come down, that would not necessarily reflect that we would be able to get back or to make back in profit all the extra costs that we've had, because we are still some time away from the maturity, and so the delta is not that significant, even though we are at the money. If of course the gamma is very high, so the delta moves quite a lot, but the delta is not that high, you see, so the price of the option does not appreciate that much, because we are still at some distance away. So as things stand at the moment, this was the first mistake, and then as we moved along with the trade, as we tried to set up the position, then we did another mistake, which is basically we sold a put. Now there is nothing wrong with selling this put, but the put on its own, selling this put on its own, caused us to not to have anymore a delta neutral position, because if you have the long strangle, all right, you are basically saying that, all right, assuming the price is more or less in here as it should be, that means that if the stock goes this way, all right, our put lose money, but our call gains money in more or less the same proportion. There are differences, it's not exactly equal, but because deltas tend to be the opposite for similar puts and calls, but it's not that linear. It's not a one-to-one relationship. But if it goes out this way, the call gain and the put loses, and if it comes this way, the put gains and the call loses, right? This is what would happen if we only have the strangle. But because we sold a put, and if of course with a different maturity, of course it would expire this week, but considering that we have a put sold here at the strike of 30.50, you will see that if the stock rises in price, our our long call gains, and our short put also gains, and our long put loses. But if the stock comes down, we'll lose on both the call and the short put, and we only gain with the long put, and so the gain on the long put will not be enough to offset the losses on both the short put and the long call. So this position was not delta neutral, and this was a mistake number two. So by selling only a put to reduce the cost of the strangle, we ended up with a long biased position, and so the position will stand to gain almost only, there may be some exceptions, but there are some exceptions, but only when the stock rises. Because if the stock falls, the gain on the long put will not be enough to offset the loss on the long call and the short put. Right? This is, of course, under most scenarios, assuming everything else is the same, because it can happen that if the volatility rises by so much that causes the call not to lose that much value, and the long put rises a lot in value, it will offset the long call, of course, the small loss in the long call, and will also offset the loss on the short put. But still, that causes us to that makes it much more difficult for us to get a profit out of this. And now, moving forward, as you can see here, on Tuesday, where is it? So let's see. So yeah, so this is still Monday. All right, so this is Monday. Now, another thing that happened was that we sold we bought back our short put, in an attempt to create a delta neutral position. Now, when we sold the put, when we bought back the put, the position was annulled, so it was countered, and so we only kept the strangle. All right, but then what does that mean is that because the stock recovered but stayed here in the middle, all right, that means that we still have the cost of the strangle, of part of the strangle, to recover, because we only sold the put, and there was still some cost to recover. And by staying here in the middle, as it was here, by around within this range, more or less, that means that it would be very difficult for us to get some money. And so that's why it's very important, when you set up the long strangle, to try to reduce our cost as possible, so that if we have to close the position before of course before the end of the week, what's going to happen is that our losses will be much minor, because we will still be able to get some of our reduced cost back, while if the cost is much higher, as it was in this occasion, yeah, the likelihood that we are at a loss is much bigger. And so as you can see, we still pursued the trade without having reduced the cost of the strangle as we should, and so the probability of loss was much higher. Now, fortunately, the market rose on Thursday, and we still came out of the trade almost breaking even. But what this means is that unless you have the stock, and I'm going to write this in here, let's duplicate here. So this is not necessarily a mistake, it's a realization. So to capitalize on the earnings release, because we don't know if the stock will go up or down, we are better off if we set up a delta neutral position, meaning just like this, like a strangle, because the delta neutral means that whatever the stock moves, the losses on one leg will be offset by the gains on the other, and vice versa. All right, basically this is it. A delta neutral position. By doing so, we hope that the loss, by doing so with a strangle, long strangle, we hope that the loss in time decay, because we are long, so the time decay works against us. Keep in mind, that's why the wheel strategy, it's profitable in the long run, because you have the time decay working in your favor because you are selling the options. But if you are long, you have the burden of the loss of time decay, and if you have a long strangle, we hope that the loss in time decay will be more than offset by the increase in implied volatility, because if the implied volatility rises, the premiums of the options, or the value of the options, go up, and that is how then you can sell the options later at a profit, because the implied volatility more than makes up for the loss in time decay, which of course causes the value of the options to come down. But here, and I recall this for Alcoa, already on Monday, the implied volatility was already quite a lot, in this case by around 10 percentage points, 10 percentage points above the historical volatility. So the historical volatility was already built in the options when we bought them. So we paid more than we should. The ideal this strategy only, or is more likely, because there are exceptions, as we saw with American Airlines, is more likely to work or to profit if we set up the strangle before the implied volatility builds up, right? And this was not the case. It was that means that we set up the position too late. If we set up the position a few weeks earlier, the possibility of profit would have been much higher. That means that the position should be set up quite early on to profit from that build up. And of course, you pay, even though the larger time to maturity means that the options will be more expensive, but on the flip side, we benefit from a slower time decay, because as I believe I already explained in one of my previous videos that if the option still has a long time yet to mature, time decay still happens, but happens at a very slow pace. Time decay accelerates when the option is closer to maturity. So if we set up the position like 3 weeks earlier than the earnings, or we set up the position with 3-week options, the time decay will be much slower than if we do that with 1-week options, for example. You see, and of course, let me just duplicate here. Oops. Here. Also, it is very helpful to reduce the cost of the strangle with short positions, but it is key to keep the overall position delta neutral. That means only capitalizes to capitalize only on volatility. That is why we need to sell calls and puts, which basically is a short strangle, right? As by doing so, we reduce the cost of the long strangle and the price changes in the short put are mostly offset by the price changes in the short call, right? So if we have also another call, which is a short call here with a strike price of 31, what's going to happen is that regardless of where the stock goes, we will still be able to offset, for the most part, not completely, never completely, but offset for the most part the impacts of price changes in our overall position. And because I didn't do that, because I can't sell short calls without holding the stock, because it's too risky. It's a naked call. The losses are potentially unlimited, and so I'm not with my trading account, I'm not allowed to do that on purpose. I decided not to be able to do that, and so I could only finance or fund the cost of this strangle with a short put. But by doing so, my position became long biased, or meaning with delta positive, and so it's being delta positive, it gains when the stock rises and it loses when the stock falls. We don't want that if we want to capitalize on earnings, because if the earnings fall, the position will lose, because because my position is long biased. So if the stock comes down by a lot, the overall position will lose money. And so there's no instead of capitalizing on volatility was our downfall. And so that is why this cannot really happen. We cannot pursue this strategy in this way. And this is exactly also the case with American Airlines, because with American Airlines we basically did the same trade here, as you can see, so but with a smaller lot size, only a lot size of 2, and we bought the calls, we bought the puts, sold the puts. We ended up with the same position. We did not sell. We did not buy back the short put prematurely, but then we saw that basically the stock. Let me see where I can find it. Yeah, so here, AAL. So you can see the stock here. So 1 week. And so here another issue was that because the volatility was already it's not yet very much built up, but it was a bit more, but still, because the stock behaved in a way in which, keep in mind, the strike price was 11.5 for the puts and 12 for the calls. So the call strike was here, and again I made the same mistake here, because the stock was actually I did not make a mistake on this one, because when I bought the strangle was around 1170, 1180, so it was a good call. I set up the strikes correctly. But here, because the position was long biased and the stock pretty much did not move that much within the next 3 days, this position was just being affected by theta decay, by time decay, which is measured by the theta, and the implied volatility didn't go up. So if this stock continued to go like this, we would lose much more money if if we hadn't sold the call, because this position was costlier, and because it was just losing time value without any increase in implied volatility, we were just basically losing money. Fortunately, the stock just spiked 12% on Thursday, and that basically saved us. And I can imagine that if we had stuck around with the position until Friday, because of this pullback, we would have reverted to a losing position overall. So it was a wise choice to basically get out of the trade as soon as possible, as soon as we got to this point. So yeah, and basically moving forward, we will not pursue this strategy again unless we can make a delta neutral position. But buying a strangle only, it's extremely costly, and only in a reduced set of scenarios this position will turn up in a profit. Because if the stock does not move, we basically lose the money. But yeah, the way it is, I think it must be, for example, with ARKK, if this is a stock, we can do something like this. And let's just see, for example, 72.21. So let's just say, for example, that we are going to sell a put and sell a call here, and then for next week we buy a put and buy a call. So here you can see the difference, that it cut our cost almost in half by setting up a short strangle to finance our long strangle. And the long strangle will always be more costly because it has a higher maturity, a longer maturity, but still this is a much better position to capitalize on the earnings, or rather on the increase in the implied volatility. But without this lag here, yeah, this position, as you can see, yeah, it basically has a max return because it is a long bias position, which in our case it's not what we want. We want a delta neutral position here, as you can see. And yeah, basically this is it. This is what I wanted to show you. In this case, it's more likely for us to get into a profitable situation, but without being able to sell a strangle to buy this one, yeah, it's much more difficult. But yeah, let me know your thoughts on the comment section down below. And also, if you want to ask me any questions, feel free to do so on LinkedIn. And yeah, feel free to like the video and subscribe to the channel. And I will, yeah, we will find another way to capitalize on profits. But for now, yeah, this is it. And I'll see you in the next video.